Hello there, I'm Patrick Stroth, Trusted Authority on Executive and Transactional Liability and President of Rubicon M&A Insurance Services. Welcome to M&A Masters, where I speak with the leading experts in mergers and acquisitions. And we're all about one thing here, that's a clean exit for owners, founders, and their investors. Today I'm joined by Skip Maynor, General Partner of NewSpring Capital. Based in Pennsylvania, NewSpring Capital, for 20 years, has partnered with high-performing lower middle market companies in dynamic industries to catalyze new growth and seize compelling opportunities. Recently featured in Mergers and Acquisitions magazine, Skip is the founder of NewSpring's dedicated buyout strategy, NewSpring Holdings. And so then you're going to find there's going to be a lot more to NewSpring than meets the eye, and we have just the person to walk us through this. So Skip, thanks for joining me today.
Thanks, Patrick. Happy to be here. Thanks for having me.
Now, before we dive into all things NewSpring, let's give our audience a little bit of context, and we'll start with you. What led you to this point in your career?
Well, I guess I've been in private equity for about 26 years now, so it's been quite a ride. And I think I started my private equity journey when I was in college, when I started two companies. I wasn't the Elon Musk of the time, but it was enough money to pay for beer and a couple of books maybe. But after I graduated from college, I started two additional companies, and I really think, again, that's where I started in private equity, because I've always, really, I think, taken a highly operational approach to the companies that I've ultimately invested in my career. I was 23 years old when the bank called me and told me I wasn't making payroll, and I had to figure it out. So I've sat on that entrepreneurial and that founder side of the table. I went back to business school after selling two of the companies, and really, part of the reason I went back to business school was to, a small business owner oftentimes feels like the world revolves around them, and it was far from the truth. And there were things happening in the macro environment that I really wanted to understand. And so graduated from Wharton in '95 and got into private equity really in the mid '90s. So I've seen a lot of the cycle and a lot of the maturation of the industry. I think when I graduated from Wharton, probably less than 5% of us went into private equity. That's probably closer to 25-30%.
Yeah.
So it's been a great ride. I've again seen many cycles, and thankfully around to talk about the cycles.
Well, now, contrary to its name, NewSpring, I mentioned in the intro, is not new to private equity. You're one of the rare firms out there that's been around now for 2 decades. So as we get in and we talk about NewSpring, let's kind of open it up with, I always like finding out, the culture of a company or the insight if you figure out, how they came up with their name, specifically because it's not named Maynor Capital. So let's start with the name. Tell me about NewSpring.
Yeah, well, I think it's all about, we're all about growth, and we're all about formation. And I think, just the combination of really that, ideas springing forth and surrounding them with, with this idea of how to take companies to the next level. NewSpring seemed like an appropriate name. I can't take credit for it. Some of my partners and predecessors, could. But again, I think the culture around, again, we focus on the lower middle market. And again, so that could be companies in our definition between 10 and 100 million in size. Those are, even at 100 million, still very small companies in the whole scheme of the world. And I think that the notion of NewSpring really helps, we want to take a fresh approach to, the company building experience.
Well, and it sounds like you're on the beginning of a cycle. You're not at the end of a cycle. So you got that emphasis, and as being, experienced at 20 years, again, it's really impressive, but 20 years in this space, you're not doing just one thing. NewSpring is a series of a number of silos. Let's talk about those for a moment.
Yeah. And it's a fun story to talk about, because again, the longevity of the firm, again, I can't take credit for it, is really, really impressive. So, and I guess I'm proud to be a part of it. We just invested our $2 billionth Over that 22 years that we've been involved in 184 companies. And what's really interesting, and this talks a little bit about the maturation of private equity, it took us 17 years to invest the first billion, and then it took us 5 years to invest the next billion. And we do that we have 5 investment strategies. Again, each focused on a different segment of what a lower middle market company might need. So I'll get to my segment last, but we have a growth strategy that invests in software and tech-enabled services companies. They just closed their 5th fund, and they do minority equity capital onto the balance sheet of companies that really need a last round of capital to get them to profitability. Their average, I think, company investments is maybe 20 million in revenues. Our healthcare fund, which they're closing their 3rd fund right now, is focused on, again, similar growth stage companies, but tech-enabled services companies all around the healthcare space, specialty pharma and niche clinical providers. And then we have a mezzanine fund. Our mezzanine fund is closing their 4th fund, and that is focused on subordinated debt and really supporting other private equity sponsors into buyout transactions. And then we recently founded what we call NewSpring Franchise. NewSpring Franchise is a group started to really buy into compelling and interesting franchise and multi-unit businesses, consumer-oriented businesses. And then what I run is what we call NewSpring Holdings. NewSpring Holdings is our buyout function that we started in 2015. And what we do is do controlled buyouts into founder and family-run businesses. We really like to find companies that have been on a journey for 5 to 20 years, but may have a transition issue or a desire to grow to the next level and want a partner to do so. So again, it's with those 5 strategies that we kind of look at the lower end of the market. And again, it's a nice broad horizontal approach where really a lot of the need that a middle market company might have, or lower middle market company might have, we can solve in this building.
Well, that's something because, and I've got a real soft spot for the lower middle market, particularly because you've got owners and founders that started with nothing and created tremendous value where, like I said, nothing existed before. And they don't know how to get past that inflection point. There are some that are content to stay where they are, but there are others that want to, they either, by just their success, they're a victim of their success. So they either get to the inflection point by becoming, they're too small for enterprise, but they're too big to be small. Mm-hmm. And they need some outside force or outside assistance to help them. And if there aren't, experienced owners that have gone through that process multiple times, they don't know where to turn. And if they don't know anybody, by default, they go to an institution or a brand name or something that's out there. And they really are left short. And what happens is, unfortunately, they're underserved, but they're overcharged. And that's why it's helpful to have firms like NewSpring out there that are really committed to this segment. Talk to me about the issue where you've been around, again, I keep hammering on this, but you've been around for over 20 years and you did not scale upstream in terms of deal size. Mm-hmm. Why is that?
Well, I think it's because we love the opportunity at the lower middle market. I mean, again, you have that's where most of the companies are, and if you look at where where we are in the cycle, the oldest baby boomer right now is 75 years old, and we're in the midst of what's going to be, as these baby boomers age, the largest transfer of wealth in the history of the world. It's something like $10 trillion that's tied up in family-run businesses. And we wanted to be a part of that. So that's why NewSpring chose to stay and keep our fund sizes small, so that we could continue to really be experts and build a preeminent firm that focuses on these lower middle market companies. And you're right that the needs are very different. Patrick, you hit the nail on the head. Which when you find a business owner that's as a $40 million business and they're making $5 million in EBITDA a year, and they're at a point of inflection. And in order to grow the business, they may have to take the EBITDA backwards, or go on a hiring spree, or do things they haven't done, like go international. What we've done is build our firm to serve all those needs. And really it starts with being able to apply a different risk profile. An owner, all their eggs are in one basket. And when we do a transaction with an owner, we'll go in and we'll say, look, we're going to provide you with an ample amount of liquidity today so you can diversify your wealth. But then we'll ask the owner to roll in 20 to 40% of the ongoing transaction. And frankly, as an owner, that's like having somebody manage your wealth for you. But it's just in your private equity asset, because what we're going to do is apply our approach. And what we've done at NewSpring Holdings is really build this go-to-market strategy where we've surrounded ourselves and our ecosphere with very senior executives who have built businesses. Again, we're not former investment bankers. We're former operators. One of my partners ran a $2.5 million business that he built organically and through 100 acquisitions over a 30-year career. And we've surrounded that team of functional operating experts, where we can go in, and if we get involved, these are our experts that help take a company and position it then for different organic means that we might bring to the table, or a significant amount of M&A. We have 4 companies in my portfolio today. We've done close to 30 acquisitions in the last 5 years into those 4 companies. And we really think you can create an exponential outcome by doing both organic and acquisitive tactics.
I think it's just a competitive advantage that I hear you have. One of the questions I ask is, what do you bring to the table? But I think clearly this operational approach and growth through operation is a huge advantage over other firms or investors out there that are more financially guided. And I think that by doing this, I can imagine just putting myself in the shoes of an owner. I want to grow, I want to change, I want to do this, but I don't want to bet the company on it. And there's no margin for error. And so you don't only need the expertise from somebody that's outside that cares and wants to partner with you, but you want to be able to diversify, your wealth so that you aren't betting your entire future on a change that you need to do anyway. And so I think it makes it a lot easier.
Yeah, we call it a different lens of ownership. Again, it's an owner's going to make a certain decision that we would all make a rational decision, if they own 100% of one thing. And this really allows you to expand and put a different lens of ownership on. Again, we're not an ATM. Money isn't free. But again, if an owner is able to diversify their wealth, they could make different decisions. And then again, by sitting next to us, you've got the former CEO of a $3 billion company. You've got we're going to put board members on the company that are industry experts. And on our boards today, we have the former CIO of Comcast and the former chairman of NASDAQ and other really preeminent individuals that are going to be the industry guides. And then we've got the functional guides that can fill in holes if there's holes at the companies, or that can be strategic advisors to those companies as they embark on what is a new kind of op tempo and a new kind of way of looking at the business.
The other advantage I see for private equity over strategics and other M&A investors out there is, and you had mentioned this with the rollover of equity, is the opportunity for a second bite at the apple for owners and founders, which I think is great, where they go ahead and agree to hold on to a 30% minority stake in their company, and that 30% in 5 years could be worth more than the 70% that they got at closing originally. And I think that's a formula for success. How could anybody turn away from that?
Well, and I can promise you that we work every day to make sure that happens, because that's the way that we're going to make money. And look, at the example is this: that if the 4 companies we own today, the aggregated revenues when we got involved in them were about $50 million. Today, they're over $700 million in revenues and about close to $60 million of EBITDA. So those owners and the stake that they've rolled in and retained is benefiting from that. And for me, losing sleep every night over how we're going to make them all successful.
And of course, we put in the disclaimer right now that past performance is not an indication of future results and all that good stuff. But I mean, you were seeing this because you've got a lot of, very smart people, and they're all committed, which I really appreciate too. And that part of the passion of the lower middle market is that trust that you're all kind of pulling in the same direction. And that's outstanding. As great as all this sounds, I'm sure, some listeners are sitting there saying, how do we get in on this? Give us a profile of your ideal target. What is NewSpring Holdings looking for?
Yeah. So again, this is the NewSpring Holdings segment of NewSpring, but we look for companies, let's say between 10 and 50 million in revenues. What we do is like to get started with, again, it's a term everybody uses, with a platform. And what we will have done prior to that is really try to take a deep look at an industry where we believe there's a decent amount of fragmentation. The companies that we target are all profitable, and because we do use a small amount of debt, in all of our transactions, and then we'll come in. We will, again, when we get involved, we buy a majority stake, give an owner a nice payday today, but let us, move into the driver's seat with that owner as a partner, that we can create the best outcome together. And so then what we'll do is we'll launch into a program where we, again, if we've gotten involved, we think that there's a lot of fragmentation, and then we will try to aggressively not only work the 100-day plan where we're putting the organic growth tactics in place, but then do a significant amount of M&A around that. And so, really, it's an owner who would want to get involved with this. It's an owner that's saying to themselves, well, gosh, I know there's something better out there, but I don't want to do it, as we've talked about. I don't want to take that risk. But it's an owner like that. It's an owner that may have, may not have a way to, transition the business. May not be a stated succession plan. And so, those are places that we can, that we find that we can, really maximize.
Gotcha. With and in terms of industry, because you got a healthcare group and you've got the franchise thing. Industries, geographies, any kind of limitations or anything?
Yeah, primarily U.S. based, and then we tend to look at the world through a horizontal view, and that means we look for tech-enabled services companies, and so we look for a type of company, and that puts us in different vertical markets. In our 4 companies today, we're in fintech, government services, last mile logistics. Think about e-commerce, et cetera. And then cloud. So again, different vertical markets, but the types of dynamics we find at our companies, really pervade the vertical market. Again, what you usually find when we go into a company is that they don't have a big sales force. They haven't focused on marketing. The finance organization is usually used as a way to know how much cash they have in the bank and how much their taxes are. And so what we try to do is turn each one of those functional groups into a strategic weapon, and really help position for growth. That, again, when we deliver the company, to the next level, it's we've scaled it, we've de-risked it, because a lot of times companies have customer concentration or supplier concentration or owner concentration. So what we would have done is diversified all that, and that should mean that we deliver to more the middle market, that a company that has significantly less risk attached to it.
Well, I was on the exit side for this. The firms out there are getting bigger and bigger, and you've got SPACs, and so there are all these bigger entities, buyers out there for your lower middle market, that when they're ready to graduate, there's a whole very eager marketplace looking to make the acquisitions. Tell me about an epiphany that you witnessed with one of your portfolio companies, where you mentioned the 100 days, where you come in, you do the analysis, and you've got the game plan, and you have laid out a plan of action. And tell me a time where in those early months, you just saw that owner and founder all of a sudden see the light bulb come on and say, I never thought I could pull this off. Anything like that?
Yeah, look, it's and this is why I love what I do
Yeah.
because we really think that we create fundamental value. Again, there's a lot of ways to make money, and financial engineering and levering companies up and cutting costs, that may be one way. The way we make money is through growth, and so it's really fun. Again, a lot of the companies we get involved with, have not been in growth mode. Again, for the reasons we've talked about, and so I think one of the most fun things is when we come in, and again, I've heard this many times, from founders. Well, we tried to hire a sales force. I had a sales manager. I went through 3 of them in 2 years, and it just wasn't working out, so we just gave up.
That's painful. Yes. Those are painful times.
And so it's really hard to grow a company unless you again turn sales into a real function with real strong people. And so I think one of the most fun things is to, again, we have the experts here to start to bring in and build that sales function. And it starts with better defining the customers, better defining who you don't want to do business with, as well as who you do want to do business with. Because again, a lot of the things we find are, again, any revenue is good revenue, and that's not always the case when you want to grow. And so, really the most fun epiphany is when you start to see the effect of bringing in an institutional quality sales team, and you start to see those growth numbers tick up because organic growth is oftentimes, far cheaper than any other type. So.
Oh, I just a lot of fun, particularly that, because I would think, either labor, personnel, or sales, marketing are those very nuanced types of practices that are really tough, and they're very scary. And that's something you bring on there.
Mm-hmm.
Now, you've had over close to 200 acquisitions throughout this whole tenure. Let's talk real quick about how that process has changed, because it's gotten a lot easier for the whole M&A process. And one of the ways that's gotten easier is to reduce risk for the parties involved. And, that's being done now by a product brought in by the insurance industry called reps and warranties insurance. And the purpose of the product is essentially it takes the indemnity obligation between seller to buyer, transfer that away from the seller for a couple bucks for premium to an insurance company. Therefore, if there's a breach of the seller reps, rather than a major escrow or fear of a big clawback by the buyer who's been financially harmed because even though they did the diligence, something was missed. And in a perfect world, nothing would be missed, but that happens. And so this product has become a very elegant tool that's now available for the lower middle market. But, don't take my word for it. Skip, good, bad, or indifferent. What's been your experience with rep and warranty insurance?
Yeah, look, it's for perspective. I remember the first time I used it was maybe 15, 16 years ago, and trying to find somebody to underwrite, rep and warranty insurance, there was sagebrush rolling through the streets. It was a very different market. And, so I think you're right. It has increased the lubricity of getting a transaction done today. So we use it in 85% of our transactions today. It really takes, it works just like insurance. Instead of one owner, basically having all of the risk of, again, having made a mistake or having some warranty claim come up from, 5 years ago, it'll again allows the pooled interest to underwrite to that. And it's only the exception where we don't use it in the significant amount of transactions we've closed in the last 5 years.
Yeah, I think the nicest development in the success of rep and warranty has been eligibility has increased, not tightened. The claims haven't hurt the industry, and very much at all. So rates have been low. They're beginning to rise solely because of demand. Demand for the product has gone way up, and that's what's driven it. One of the things I did want to point out, because it's just not broadcast that often, is that rep and warranty was originally reserved for deals with a transaction value of $100 million plus. Just pre-COVID, that threshold had dropped by a couple of markets down to deals as low as $20 million in transaction value. There is now, as of July 2021, a market out there that has a product that can insure M&A deals with transactions from 1 million transaction value up to 10 million and insure the entire transaction. Slightly different product. It is for sell side deals. But what we think is important is that as the market grows, that there are just different options available out there. And what we like is just the sheer number of add-ons that are happening. And so there may be preferred destinations for platform investments. There are going to be way more add-ons. And if you have tools that are now available for those add-ons, all the better. Skip, as we record this right now, we're passing through the pandemic, and now we're dealing, us Californians would almost call it the aftershocks with the Delta variant. So things are kind of hanging on. But we're coming in now, we're racing into end of 21, looking at 2022. What trends do you see going forward, either macro or just NewSpring yourself?
Well, it's first of all, again, the dealing with COVID, I think we all know that we thought the vaccine was a total panacea. I think it's definitely helping, but I think COVID is now becoming more perhaps a longer term part of our overall lives, and so that op tempo that COVID has created. There's no, it's not going to go away, anytime soon. So I think we think we're going to deal with an economy that is affected by that. At the same time, there's a lot of dollars sloshing around in the economy. With what the Fed has done and what the Treasury / Congress has done at the same time. There's a lot of capital out there, and thankfully. The quick action, that the government and Fed did back in March, April, May last year, served its purpose. I think 2022 is going to be a great year. I do worry about, going further out that, we are going to see, some issues in the economy. Our companies are already seeing wage inflation. You can take price hikes, away, but, you don't take wages back.
No, that's true.
So, with a lot of the things that happen with COVID, some of which are good, some are bad. Number one, a lot of people decided to retire and are not coming to back to the workforce. So that takes a significant pool away. The lack of immigration over the last 5 years. We need immigration to grow our economy. On the good side, a lot of, I think the most business formation in the history of the country in the last year. So that's a good thing. Yeah. So look, there's a lot of good and bad. I think the key to founders and other people in private equity is you always have to assume that again, I've been doing this 25 years. I think this is my third downturn, I guess we're in an upturn now, but, they're going to talk about it. Things go in cycles. And so you have to invest and run your businesses thinking that, take advantage of what you can, but know that you've got to architect for the downside. And look, we're doing the same things, today that we were doing, last year. It's a seller's market. It is not a buyer's market because there's all those dollars out there. So it's a great time to be a seller. We have to be disciplined. And, I guess our thought is that if we do our right things by picking the right companies and then running our game plan, that we can create the growth dynamic that allows us to kind of, succeed in upturns and downturns.
Skip, how can our audience members find you? How can we find NewSpring Capital?
Our website is NewSpringCapital.com. We are in Radnor, Pennsylvania, right outside of Philadelphia. My email is smaner@newspringcapital.com, and happy to talk anytime.
Great. Well, Skip, a lot of fun. It was a pleasure speaking with you today. Thanks so much.
All right. Appreciate it, Patrick. Take care.